Hi, this is Mike O'Donnell with OG Private Wealth, and welcome to this week's edition of Fearless Fridays. This week, I wanted to talk about portfolio structure, specifically the role that stocks and bonds play in everybody's accounts, and how we use them to help our clients stay disciplined through upswings and market downswings. I've definitely received questions over the past few months, such as, maybe I'm not a stock market investor anymore because I don't have the time to recover. Or I'm not a long-term investor. Or can I even take risks? Can I afford to take any risk in my portfolio? And the fact is, most people need to take at least some element of risk. And even the safest portfolios do have stock market exposure. You see, portfolios do need to keep pace with inflation so that you can have the same lifestyle today as you want in the future. $75,000 today of income, 20 years from now, needs to double, just to buy the same things that we're buying today. So what I want to do today is, when we look at portfolios, I want us to understand that there's different components of them. There's safe things and risky things. And our entire portfolio is never dropping, and it's also never rising. So that being said, I'm going to jump in to this presentation. And I know my brother shared with a few weeks ago this chart with you, and this is really the emotional roller coaster of a stock market cycle. And the only reason I'm showing you this today is we've had so many emotions in the last couple of months, from extreme fear to all of a sudden things are feeling better. And I don't know if we're out of the woods yet on this, but things are definitely a different feeling than it was a month ago. Okay, so people look at their portfolios and you see your account value, and then you see it go up and down. And most people don't ever really jump in to look at really what's going up or even what's going down. They just see it went down big or it went up big, especially lately. Now, in a 60% stock, 40% bond portfolio, 40% of your portfolio is very safe. It's the 60% that brings all the risk and also brings all the volatility. Now, I'll show you that here, going back to 1990, the stock market, which is this top 100% stock portfolio, goes up big and also down big. Right? But it's also what provides us the significant growth over time that, when added to a portfolio, will help it beat inflation. Bonds, however, keep pace with inflation and don't go down very much ever and don't go up very much ever. It's important because when stocks are falling, bonds are very consistent to flat. Okay, us adding bonds into anybody's portfolio, whether you're younger or older, we're doing so in an effort so that we can maintain your portfolio structure through up and down, so that you're not getting too scared when markets are falling, but you're also not feeling like you missed out when markets are rising. You see, we can tell you what your expected return is going to be. Your actual return, however, will be derived from how well you stick to that portfolio through upswings and downswings. Now, this green portfolio is a blend, again, 60% stock, 40% bonds, of these stocks and these bonds since 1990. Now, again, looking at this $1 million portfolio, there's 600,000 in stocks, 400,000 in bonds. Okay, again, two distinct different asset classes. Now, what we're going to look at in my example is, we're going to look at a person spending 5% a year off their accounts, $50,000 per year. We're going to assume that we're in a massive market downturn where stocks are down 50%. Again, stocks have not fallen that much in this recent downturn. And we're going to assume that bonds are flat. Bonds have held flat, and they typically do through any major up or downswing. So this 50% downturn is going to affect the portfolio by dropping it 30%, or $300,000. Again, we're using $1 million as our number to keep numbers simple. So now your account went from $1 million to $700,000. Again, everything didn't just drop, just the stock side. Okay, stocks now have went from $600,000 all the way down to $300,000, whereas your bonds stayed high at $400,000. So what we're doing is, we've built in enough money for you to have 8 years worth of withdrawals should things really get bad. And the reason we use 8 years, is because that'll get you through any stock market downturn, including the Great Depression. Okay. Now, the reason we want to make sure you have enough money in cash and savings is because we want to be able to do other things with your portfolio when markets are turning down, such as maintaining the portfolio structure. Okay, we want 60% stock, 40% bonds. That portfolio gave us a certain risk and return as well as liquidity for you. So what we need to do now is sell bonds and buy stocks. And this brings us right back to our 60% stock portfolio. You have money in cash and savings, whether it's in your investment portfolio or at your bank. So we can sell our bonds to buy more stocks. This again brings us right back to the portfolio we'd originally wanted. What happens ultimately? Markets always recover, and they always do because things continue to get better. But because we made this shift, because we rebalanced when things were low, your portfolio now has turned from $1 million to $1.12 million. You've now made $120,000 on the exact same portfolio with the stock market never going higher than it originally was. We're not done here, however, because now your portfolio is much riskier than it originally intended it to be. Right? We want 60% stock, 40% bonds. So what do we need to do? We need to sell $168,000 out of your stocks and put them back in our safety bucket. Again, that's going to help us in the next downturn have enough liquidity and safety so that we don't have to sell stocks when things are down. Again, we can tell you what your expected return is going to be. Your actual return is going to be derived based off how well you stick to that portfolio through upswings and downswings. Have a great Easter and enjoy the time with your family, and we'll talk to you soon.